In this video, I'm going to talk about a tax rule called the at-risk rule. This rule is relevant for anyone who is a business owner or anyone who invests in real estate. I know this isn't one of the more fun parts of tax planning. We're not talking about strategies to reduce your taxes. We're talking about rules that can limit the losses you claim on your tax return. So I'm going to keep this video short, sweet, and to the point. In most cases, you should be able to rely on your CPA to understand how this rule works. There are a lot of nuances, but I'm not going to cover that. I'm just going to give you what you need to know, which are the highlights. So let's dive right in. Basically, the at-risk rule is a rule that limits your ability to deduct losses. So under the rule, you are only able to deduct losses up to the amount that you have at risk in an investment. So to say that otherwise, you're basically limited on the losses that you can take to the amount that you stand to lose in that investment. As I mentioned before, this comes up mostly in the context of a business, especially when you're operating a business where you are borrowing or taking on debt to fund that business. That can be a common situation where you see this arise, as well as real estate investing. So I'm just going to start with a basic example of how this works. Let's say Mary starts a business and she puts in $10,000 of her own money, and she's also going to borrow from the bank and take a loan of $10,000 to start her business. So she's got $20,000 to fund this business in the first year, but she only borrowed $10,000. So if in year one, the business has a net loss of $15,000, Mary is only limited and able to deduct up to $10,000. So she can't deduct the full $15,000 because she's only able to deduct the amount she has at risk, which is her $10,000 equity she put in the business. One exception to this, and this may apply in this example, is that if you have debt and you are personally liable for that debt, so if it's a recourse debt where you could be, if you don't pay back the bank, or if her business didn't pay back the bank, if the bank could then come after Mary personally to pay off, that $10,000 loan she borrowed, that actually counts towards the amount at risk. So going back to this first example with Mary's business, if she had a personal guarantee on this $10,000 loan from the bank, Mary actually can deduct the full loss of $15,000 because once you put a guarantee on a loan, you are personally liable for that loan. So you could stand to lose that amount in that investment. So any amount of debt where you are personally liable, or, we commonly call that recourse debt because the bank has recourse to come after you to satisfy that debt, that increases the amount you have at risk. So that's very important. And, most of the times when you're borrowing, if you're a small business, it's very rare that the bank that's lending to you is not going to make you do a personal guarantee. So it's a very unlikely fact pattern that someone would be starting a business and getting a non-recourse loan. But let's just say you are, then, that non-recourse loan where you're not personally liable, they can only come after the business, that doesn't count. But if you are personally liable, it does count. So you need to understand that when you're calculating your amount at risk. The other situation that commonly comes up is real estate. So there's a little bit of differences in how we treat the debt for real estate. Sometimes with real estate, you actually can be considered at risk for non-recourse debt. So for example, there may be a situation where you invest in a real estate fund or syndication, and the bank that lends with respect to that property cannot come after you personally. But so that would be a non-recourse debt, right? Because you're only able to lose the amount that you invested. But in some limited situations with real estate, you can include non-recourse debt. I'm not going to go into that in detail here. But let's say a basic example of how this comes up is Mary goes out and buys a real estate property that she's going to rent. So she has this rental unit that's worth $1 million. She puts the typical 20% down. So she has $200,000 equity. And she takes a $100,000 mortgage out to buy the property. So very common fact pattern in real estate. Also, let's say Mary, used bonus depreciation or some way to have a big loss in year one of $250,000. That's her net taxable loss. And that's also a very common fact pattern. In many cases, it could actually be a lot higher than that under the current bonus depreciation rules. But this is a very common fact pattern for real estate investing. Because Mary is considered at risk for the full amount of the debt, then she actually can deduct the full loss here. So even though Mary only has $200,000 of equity in the property itself, she is still able to deduct the $250,000 because she's got really $1 million at risk. Because if she doesn't pay off this $800,000 mortgage, if the rental property, fails and can't pay that out, then the bank's going to come after her, right? It's very few situations where a bank is going to lend to someone and say, we're going to make this debt not personally liable to the owner of that property. I, very rarely see that outside of very large commercial real estate type contexts where you are investing through a fund or with a bunch of, very, very big and other investors putting a lot of money together. So in this case where you're going out and buying rental units yourself, you're almost always going to be personally liable in that debt. But the good news for that is that you do get to deduct the full loss in year one. Watch out for the passive activity rules. I am only speaking with respect to at-risk tax rules here. And, to the extent you can't just say, I meet the at-risk rules, I can deduct the loss. You have to go through other hurdles. So passive activity rule for real estate, business, anything where, you could be considered passive with respect to that investment, you also have to take that into account. So if you're not familiar with that rule, check out my video on the passive activity loss limitation rules. Last thing I want to mention is that if you have amounts that you're not allowed to deduct, so say we go up here, Mary can't deduct the full 15, she can only deduct 10. She actually carries forward that extra 5,000 loss that she wasn't able to deduct currently, and she can deduct that in the future when she has enough net income. So once the business goes positive, she can then use that previous loss that's carried forward and offset that positive income. So again, this is just a very basic overview of the at-risk tax rules. It's something you need to understand if you're going to invest in real estate, and also something you need to understand if you're going to, take out a loan to fund your business activities.